Once this deal is done, we'll be in 11 time zones. Who do we have handling this?
BDO.
And over there?
BDO.
People who know BDO.
Hi, everybody. Welcome to On the Money. I'm Maria Bartiromo. The markets hit new highs, but are we ripe for a correction? What do the weak jobs numbers mean to you and your portfolio? Then legendary CEO A.G. Lafley will join me. The man who ran Procter & Gamble talks about today's CEOs and what they're doing right and wrong. Plus, the dean of one of America's top business schools on the surprising reason college tuition is so high and the lessons America can learn from developing countries. On the Money begins right now.
This is America's #1 financial news program, On the Money. Now, Maria Bartiromo.
Here's a look at what's making news as we head into a new week on the money. A weak jobs report for the month of March released on Friday. The employment report released showed the economy created just 88,000 new jobs for the month. That was the fewest number in 9 months, well below analysts' expectations, who expected 200,000 new jobs. The unemployment rate fell to 7.6%. Now, that was the lowest in 4 years, but that was only because fewer people were actually looking for jobs. One piece of good news, the number of jobs created for the previous 2 months, that number was revised upwards. Choppy was the word of the week for stocks. The Dow and the S&P 500 hitting new record highs on Tuesday on strong auto sales, but then had their worst day in a month on Wednesday, partly on concerns about North Korea. The markets fell later on in the week on those jobs numbers. Another sign of strength in the auto sector, GM, Ford, and Chrysler reporting their strongest March vehicle sales in 5 years. Sales were boosted by gains in the housing market and construction, which pushed pickup truck sales. The Securities and Exchange Commission has entered a new era. Federal regulators now say companies can legally use social media to announce news to investors, so long as investors are notified ahead of time. The ruling stems from a posting by Netflix CEO Reed Hastings last year on his Facebook page. The company said that it had surpassed 1 billion viewer hours per month at the time. Well, the monthly jobs report, the big kahuna the markets have been waiting for. What does the number tell us about the economy and where we are and the impact it has on your portfolio? Joining me right now to talk about that, Lakshman Akutan. He's Economic Cycle Research Institute co-founder and Chief Operations Officer. And David Kelly, J.P. Morgan Fund's Chief Global Strategist. Gentlemen, good to have you on the program.
Glad to be here.
Thanks so much for joining us. So were you surprised at the jobs report on Friday? 88,000 new jobs created in the month of March, the fewest, the worst report in 9 months, well below expectations.
I was a little bit surprised, but statistically, these numbers are never as close as people think. I mean, our best model for payroll employment is a standard error of about 80,000, which means 2 out of 3 times you'll be within 80,000 of the estimate. The rest of the time you'll get a surprise. So it was weak, and it was a little bit of a surprise on the weak side, but it's not, I don't think it's dramatically weak.
Now, the weakness, Lakshman, you think we're in the early stages of a recession?
Yeah, I think it began last year, and so a jobs report like we saw on Friday is consistent with that view. Of course, you have the payrolls at 88. If you look at the household, you lost jobs, a little over 200,000 on households, and year to date, you've lost jobs, according to the household survey. And when you look at the year-over-year growth rates of either, the payroll jobs survey is now at a 19-month low. The household jobs growth rate is now at an 18-month low year-over-year. So that's a very contrasting picture to a reviving or a healthy economy.
I pretty much completely disagree with that.
Okay.
I do, obviously the jobs report is weak this month. It's actually been pretty strong for the last few months, but it's weak this month. But I'd look at 2 other things. One of them is wealth. We know that in the first quarter of this year, because of rising stock prices and also because of rising home prices, the household net worth rose by, we estimate, about $3 trillion. That is equal to about 20% of GDP. Now, I know that's a wealth effect as opposed to an income effect, and income is more important than wealth.
The wealth effect being the stock market going up.
Yeah, the stock market goes
richer.
up. Yeah, so when people look at their 401k statements for the first quarter, many of them are going to be back. Now, they will have recovered all their losses from the financial disaster. And we were also seeing home prices higher. And I think that also is supporting consumer spending. And that is actually feeding into a second thing, which I think is very relevant, which is real GDP, we think, will be above 3% growth for the first quarter. It could even be 4%. So, I mean, we got wealth, the jobs aren't great. Wealth is good, very good. output growth is good. So, to quote Meatloaf, 2 out of 3 ain't bad.
What about the stock market? I mean, a lot of people, everybody you ask is saying, well, we're up 10% year to date. This market has to come down. It has to fall. Are we due for a correction at this point? Do you think the market is valued appropriately?
I think the market is valued appropriately in absolute terms and is still valued cheap relative to fixed income and cash. The biggest actor in all of this is the Federal Reserve. The Federal Reserve is like an elephant sitting on the long end of the yield curve. And they're making it very difficult for people to make good money in fixed income, good money in cash. And that is gradually pushing money towards the equity market. So when I look at the stock market overall, when I look at PE ratios, earnings yields, price to book, it looks about normal valuations, fair value. But relative to cash, relative to inflation, relative to interest rates, I think the stock market still is cheap. We will get a correction at some stage. I just don't know when it's going to start or when it's going to end.
So you would put new money to work in stocks right now then?
Oh yeah, I would, because it's sort of what I would call the TINA market. There is no alternative. I think you have to put money into equities as part of an overall long-term investment plan, knowing that there are going to be times during this year and the next few years when you're going to have a correction. You just can't time that. But long-term, I'd be overweight equities.
What about that, Lakshman, the Fed? I mean, a lot of suggestions this week that the Federal Reserve is going to start unwinding that $85 billion a month of bond buying. If we were to see the Fed wind down this stimulus by year end or next year, does that create a problem for the market on top of what you're saying is already early stages of recession?
Well, yeah. So first on the market, the Fed is obviously a big player in this market psychology, and just it is a fact that corporate earnings growth, while quite high operating earnings growth, it contracted in Q3 and Q4. It fell off of its highs. So we are seeing some economic impact on corporate earnings, but the stock market doesn't want to fight the Fed, and I'm not going to argue with that at all. With respect to the economy, which is quite different from the Fed, here let's talk about exit strategy. This will be, I think, the 4th time we're bringing this up since the end of the Great Recession. It started in 2010, then in 2011, then in 2012, and now we're starting this exit strategy talk again. They're going to have to walk it back, given our view. Because if they, like other central banks, keep doubling down on this policy of more and more support, trying to push off recessions, they're going to, they're kind of stuck. They're in for a penny, in for a pound. And so I would expect them to actually kind of walk back this exit strategy talk as they've done a few times already.
What about earnings? The first quarter reporting season beginning on Monday. Alcoa is going to be kicking off, and then we've got Wells Fargo, JP Morgan later on in the week. Not great shakes for earnings expectations. 0.6% growth in the first quarter versus a year ago. Is the market ahead of itself based on what's going to be likely a slow earnings period? And we've seen blow-ups, Caterpillar, FedEx.
I think we'll end up doing a little bit better than that on operating earnings based on what our read of it. As I said, I think real GDP growth for the first quarter is going to be about 3%, might be a little bit higher than that, and I think we will get some increase in earnings in the first quarter. And it may surprise on the upside.
All right, we'll leave it there. Great to have you both on the program.
Right,
thank you.
Thank you so much, Lakshman Akutan and David Kelly. Up next on The Money, one veteran of the corner office says most of today's corporate leaders are missing something, and that something could lead to success. The man who turned the tide at Procter & Gamble shares his message for today's leaders. Then, former Defense Secretary Leon Panetta on how much we should worry about Korea, and if that's not enough,
I really do believe that the Pearl Harbor of the future could be very well a cyber attack on this country.
nervous markets this week, partly due to new threats from North Korea. The country threatening to use nuclear weapons, and the U.S. responded by moving an advanced missile defense system to the Pacific. I spoke to the former Secretary of Defense, Leon Panetta, asking him about North Korea's motivation and what the consequences may be, all part of the global conversation this week.
A lot of this, I think, is aimed probably more at the internal situation in North Korea, aimed at improving the new leader's credibility, his credentials as a leader. But at the same time, because they have capabilities and they're developing those capabilities, I don't think we can take anything for granted here. I think the greater likelihood is miscalculation, that they do something that escalates quickly. That's the greater danger.
Let me ask you about another concern, and that is, of course, cybersecurity. You've said that the United States is facing a potential cyber Pearl Harbor. What did you mean by that?
The reality is we're developing the kind of technology now that can virtually cripple a nation. You remember Hurricane Sandy, when the power went down in Hurricane Sandy, they lost their 911 capability. They lost the ability of gas stations to provide gas, of banks to provide money, of hospitals closing, all because power went out. The reality is that we now have, and other countries are developing, the capability to cripple our power grid, to cripple our financial systems, and to cripple our government systems. That could create tremendous damage.
Now that you're out of Washington, what is your assessment of how Washington is handling the issue, foreign policy, as well as, economic policy, the budget and the deficit?
I really worry about the dysfunctionality in Washington. I travel around the world. Other countries don't question our capability, our military capability, our technology, our men and women in uniform. They know we're the strongest power on earth, but they do question whether or not our democracy can function.
My thanks to Leon Panetta. While Washington's worries weigh on corporate America, my next guest is a legendary businessman with advice for success in any economic climate. A.G. Lafley ran Procter & Gamble for 10 years, where he doubled the company's sales. He outlines business's most successful strategies in a new book, Playing to Win. A.G., good to have you on the program. Welcome back.
Great to be with you, Maria.
So what do you think are the biggest mistakes that business leaders make today, which obviously you did not make running P&G with such success under your belt?
Actually, we made our fair share of mistakes, but fortunately we learned from them. As we point out in the book, we don't believe the issue is a lackluster global economy or global competitiveness or any of the rest of it. It is simply the inability or unwillingness to set a strategy, and a strategy is simply choices to win.
It's interesting that you say that, because it makes me think about the choices in Washington right now and the strategy of getting our economic house in order when, in fact, we are unable to make decisions about what to cut in terms of entitlements, what to spend money on. Is that what you mean?
Strategy is a problem in small, medium, and large-sized businesses. It's a problem in not-for-profits and for-profits, and it's definitely a problem in government. The federal government doesn't have a strategy for growth. We haven't had a strategy for energy for decades. We don't have a strategy for making the hard choices we need to make to have a budget that's practical.
How would you apply that to the real world marketplace today? I mean, this week we got a jobs report that was way below expectations. Only 88,000 new jobs created in the last month. We are sort of bumping along the bottom in terms of economic growth, and yet the stock market is rallying. How do you approach these issues?
Hey, the fundamental purpose of any business is to create a customer, keep that customer, serve that customer, and turn that customer into a loyal customer. And that customer drives your revenue, drives your profit, and drives your cash stream. And I think in a lot of cases, we've lost touch with that fundamental principle. We get trapped into this special interest group or that special interest group, this segment of the population or that segment of the population. If we're going to have an energy strategy, it's going to be an energy strategy that delivers for our country, that delivers for our consumers who reside in our country, that delivers for our businesses who use the energy to drive their manufacturing in our country. It's got to be the greater good for the longer term.
Yeah, that's a great point. And do you think energy could be a game changer in terms of getting this economy moving? Because we are rich in certain energy.
Absolutely. I mean, the simple choice to make here is for energy sufficiency and independence. I was actually heartened by some of the agreements that were made by the shale oil industry and the EPA and regulators and a number of interested stakeholders from the entire spectrum. So I think it's practical. It can be done. We just have to have the will to do it.
What about the workforce, AG? I wonder if there is this skills gap. We were talking earlier with our guests about the issues in getting job creation moving again. And a lot of CEOs come on this program and they say they actually cannot find the right skill sets, the people who have the skills that they need, that are required to actually thrive in the jobs that are open.
I think skills gap is one of the issues, but there are other issues. mobility. When people's mortgages were underwater, they couldn't move. And in every recession in U.S. history, one thing that has to happen is we have to be able to migrate to where the jobs are. I think as residential housing improves, you'll see more mobility. The other issue is, of course, the immigration issue, which is being worked in Congress, and I hope will be driven to a successful conclusion.
AG, good to have you on the program. Thanks so much.
Great to be with you, Maria.
We'll see you soon. A.G. Lafley joining us, former CEO, Procter & Gamble. Up next on The Money, are the U.S. and Europe stuck in neutral while the developing countries are firing on all cylinders? In the race for growth, what are they doing that we are not? The dean of NYU's Business School will join me. And find us on Facebook/Maria Bartiromo. Can the U.S. and Europe fix their fiscal woes and low-growth economies? One author says they can, if they take a page from the developing world's playbook. Joining me right now is Peter Blair Henry, author of Turnaround, Third World Lessons for First World Growth. Peter is the dean of New York University's Stern School of Business. In the interest of full disclosure, I serve on the board of trustees of NYU. And Peter, it is good to have you on the program.
Delighted to be here, Maria.
Thank you so much for joining us. The book is great. Why did you decide to look at developing nations and their economic policies for solving debt issues?
Well, there are 2 points here, Maria. One is personal and one is professional. On the personal side, I was born in Jamaica, moved to the United States when I was 9 years old. And when you move from a place like Jamaica where there's a lot of poverty around, although there's a real robust middle class there as well, and you move to an affluent suburb like Wilmette, Illinois, just north of Chicago where I moved, one of the things you notice immediately is, well, there's affluence across the board. So it struck me really early on, how did the U.S. do it? Why are some countries rich and why are some countries poor?
Yeah, you weren't exactly seeing the poverty that you saw growing up in Jamaica.
That's exactly right. And so that really drove my interest in trying to understand these differences. And economics provided a tool for basically understanding those differences.
So your conclusion in Turnaround is that countries should enact a disciplined growth strategy. How do you do it?
Yeah. So I think the key thing to understand first is discipline does not mean fiscal austerity. Discipline means a sustained commitment to a pragmatic growth strategy that's both vigilant and flexible and values what's good for the country as a whole over what's good for any individual or interest group. And so when you look at it that way, and you look at what developing countries have done, they have learned from the things that we preached to them in the 1980s and 1990s. And now, if we would just take a look at countries, countries like Brazil, Chile, in South America, to the countries of East Asia, there's a message there for us to basically take what we taught them and apply it at home, and to begin to start growing again and begin to get out of this period of low expectations and underperformance.
Let me switch gears, Peter, ask you about the cost of college. Obviously, tuition rising at an alarming rate, outpacing inflation. There's a debate about, is college worth it?
Yeah. So college is definitely worth it. If you look at the overall unemployment rate in the United States, it's 7.6%. It's half of that for college-educated workers.
I'm glad you said that. That's absolutely right.
That's a key thing to remember. But then you asked the really important question, what is driving up the cost of higher education? And I think the key thing to understand is the same thing which is driving up the cost of higher education is also the key thing which can be part of the solution. In other words, technological change. It's never been a better time to be an educated person. Because of technology, people's ability to work from home, work remotely, skilled workers, people with analytical skills, communication skills, are in demand. But guess what? Those really talented people are also key inputs into higher education. And so the things that are driving up the wages, if you will, of skilled workers in the economy as a whole, the demand that the rest of the world has for these workers and for higher education is what's driving up the cost.
Let me get your take on MBAs. I mean, here we are, at the time that school's almost up. People are looking to work. Are there job prospects out there? What is the outlook for MBAs these days, and are they finding jobs?
MBAs are finding jobs, absolutely. And I think the key thing to understand about the U.S. economy is we really have a two-speed or tale of two economies right now. Really highly educated people, college graduates with strong degrees, MBAs are continuing to do very well. But the middle class and less educated workers are still struggling. And the key to that is, frankly, improving our educational system.
Where's the hiring happening?
The hiring is happening in a number of sectors. So again, the emerging world is really key here. So as the middle class rises in the emerging world, They want more of what we have to reduce, but not just our beef and our grain and our capital goods. They're also interested in our entertainment services, right? And so the entertainment, media, technology sector is an area of really strong growth. And luxury.
Great point. So for a long time, all we thought was Wall Street, and yet you've got all these other sectors that are hiring and looking for
absolutely
educated, skilled workers, MBAs. Good to have you on the program.
Great to be with you.
Thank you so much.
Thank
Peter
you.
Henry joining us. Up next, a look at the news this upcoming week that will have an impact on your money. As we take a break, take a look at how the stock market ended the week. Back in a moment. For more on our show and our guests, check out the website, otm.cnbc.com. And I hope you'll follow me on Twitter and on Google+. Look for @Maria Bartiromo. First, though, here's a look at the stories coming up in the week ahead that may move the markets and impact your money this week. Earnings season starts on Monday with Alcoa's report for the first quarter, followed later on in the week by Chevron and major banks JP Morgan Chase and Wells Fargo. Wednesday, the president is expected to send his 2014 budget proposal to Congress 2 months late. And the minutes from the Fed's last open market committee meeting are out on Wednesday as well. On Friday, we were checking in on inflation at the wholesale level with the monthly Producer Price Index report. And retailers report last month's sales also coming out on Friday. That'll do it for us for today. Thank you so much for being with me. My guest next week, Cass Sunstein, the Harvard Law professor who took on regulatory reform for the Obama administration. Each week, keep it right here where we are on the money. Have a great week, everybody. I'll see you again next weekend.
Ross needs an auditor who knows the industry as well as he does. For Brian, it's whether he can call the partner at midnight.
So?
They both came up with the same name, BDO.
People who know BDO.